Okay, so I want you to picture something. It's January, it's freezing cold, you're in the Swiss Alps, surrounded by these snowy peaks, and probably some very serious-looking
And
guards.
very expensive hot
The
chocolate.
most expensive, yes. The scene is set. We are, of course, talking about
The
Davos.
World Economic Forum.
Exactly. It's where, all the global elites, politicians, CEOs, billionaires, they all gather to sort of decide the fate of the world. But we're not here to talk about the speeches. We're here to talk about a wall.
Very specific logo wall.
Right. You're walking through the venue and you see this huge display. And, a lot of it is what you'd expect. You've got the heavy hitters, Microsoft, Visa, MasterCard, Salesforce, the companies that basically run the world's OS.
The titans of industry.
But then you see it. Sitting right there, kind of sandwiched between these trillion-dollar giants, is a logo that, well, it probably confused a lot of the traditional finance people walking by.
It wasn't a bank.
No, it wasn't some huge tech conglomerate. It was Hedera Hashgraph.
Which creates a bit of cognitive dissonance, right? In that environment, you expect the old guard. You don't necessarily expect to see something that many people still just file under crypto projects.
And that is exactly why we're doing this deep dive today. That placement on that wall, it matters. We're going to unpack why Hedera, or HBAR, was up there. We're going to talk about a concept from our research called the utility cartel.
It sounds a little bit like a Bond villain's organization.
It does, but it's actually about some very serious infrastructure alignment. We're going to connect the dots between that Davos appearance, the U.S. banking system's new FedNow service, and a frankly surprising report from J.P. Morgan.
We're going to see how Hedera is trying to position itself not as, a casino chip for day traders, but as the boring, essential plumbing for the global economy.
Before we get into the utility cartel, we have to stop for a second. We have a very, very serious and mandatory disclaimer.
Absolutely. This is crucial. We are going to be talking about financial technologies, specific assets like HBAR, and even some valuation models we found in the source material.
Okay.
However, and we have to be clear, this is not financial advice.
We are not financial advisors. We're here to analyze the research, connect the dots. You absolutely have to do your own homework. Don't go buying anything just because two people on the internet talked about a logo on a wall in Switzerland.
Exactly. Manage your own risk. We're just here to help you understand what's going on under the hood.
Okay, disclaimer done. Let's go back to that utility cartel idea. The research really highlights the specific group at Davos: Ripple, Hedera, Algorand, Constellation, and it makes it clear this isn't just a random list of projects.
No, and that's the key insight. For years, the whole crypto narrative has been winner take all, right? It's Bitcoin versus Ethereum or Solana versus everybody else. It's this big battle royale.
This constant tribalism.
But the utility cartel theory suggests we're moving out of that phase. We're moving into an era of specialization.
Specialization. So looking at that wall, we're not seeing competitors. We're seeing an alliance.
An alliance of systems, yeah. Think of it like building a house. You don't hire a plumber to do the electrical wiring, and you don't ask the electrician to pour the foundation.
Okay, that makes sense.
In this new digital economy, different networks are starting to own specific layers of the stack.
All right, so let's break down those goals. Let's start with Ripple. Everyone knows Ripple.
So in this framework, Ripple provides the payment rails. Their entire job is to move value currency from point A to point B instantly, especially across borders. They're the truck that's moving the money.
Okay, Ripple is the logistics. So where does Hedera fit in? The source gives it this very specific and kind of nerdy role: enterprise-grade finality.
It sounds nerdy, but for a bank, it's probably the most critical part of the whole equation.
Finality is one of those words that gets thrown around a lot. For someone listening who isn't a blockchain developer, what does that actually mean in a banking context? Why is that Hedera's job?
Great question. So think about how the system works now. When you swipe your credit card or deposit a check, that transaction isn't really final for days.
Right, it's tending.
It's pending. It can be reversed. There's this settlement risk period where the money is kind of in limbo.
It's why payments can get clawed back or checks bounce.
Precisely. Finality in the blockchain world means the moment a transaction is carved in stone. It cannot be changed, reversed, or debated. It's absolute truth.
So it's like the digital version of handing someone physical cash.
Exactly. And Hedera's underlying math, the hash graph consensus mechanism, it offers what's called asynchronous Byzantine fault tolerance, or ABFT.
That's a mouthful.
It is, yeah. But without getting too deep in the weeds, it just means the network reaches that carved-in-stone state incredibly fast,
Right.
and with mathematical proof. So in this alliance, Ripple might move the value, but Hedera provides the time-stamped, unchangeable record that it happened.
So Ripple moves the money, Hedera provides the trust.
That's the perfect way to put it. And then you have others, Algorand for tokenization, Constellation for data validation. But our sources today really focus on Hedera's role as that layer of trust.
It feels like while crypto Twitter is arguing over meme coins, the real infrastructure players are quietly carving up the actual territory.
That's the Davos signal. It's not about hype. It's about integration with the people who write the laws and run the central banks. And that leads us directly to the second part of this, the U.S. banking system.
Okay, so we're leaving the snowy mountains and we're heading over to the Federal Reserve to talk about FedNow.
Yes, FedNow. And we need to clear up some myths right away because the internet is very, very confused about this.
Please do. I keep seeing things like FedNow is a blockchain or FedNow is the government's crypto.
It is neither of those things. FedNow is just a payment rail. Think of it as public infrastructure built by the Fed to let banks settle payments instantly, 24/7. It's an upgrade to the old system where money took, 3 days to move.
So it's just a faster highway for dollars, a modern pipe.
Correct. But here's the problem. A highway's dumb. It just lets cars drive. It doesn't know why the car is driving or what's in it or if the driver has permission. It just moves the vehicle.
And banks need more than just movement. They need logic. They need smarts.
They need programmability. And this is where Hedera comes in. The source material is very clear about this. Hedera is not trying to replace FedNow. It sits on top of it.
So if FedNow is the highway,
Hedera is the smart logistics layer. It handles all the logic, the receipts, the tokenized assets, the conditions.
okay, give me a real-world example. Why do I need Hedera if FedNow already moves the money instantly?
Okay, imagine you're buying a house. You have to send a huge down payment, right? Maybe $100,000. FedNow can move that money in seconds. Boom, it's gone.
Right. But I don't want to send it until I'm absolutely sure I'm getting the deed to the house.
Exactly. You don't want to send 100 grand into the void and just hope the other person signs the paper. FedNow can't help you there.
Yeah.
But if you layer Hedera on top, you can use a smart contract. But the contract basically says, when the digital deed is verified on the Hedera network, then and only then trigger the FedNow payment.
Ah, so it creates a conditional risk-free payment.
It creates what's called atomic settlement. Delivery versus payment. Both things happen at the exact same time, or neither happens at all. It removes all that risk.
That makes perfect sense. So FedNow is the muscle, Hedera is the brain.
Perfect analogy. And look, this isn't just a theory. The research points to a specific company called Bank Social.
This part I found really fascinating because usually when you hear about crypto adoption, it's also vague, partnerships that are just press releases. But this seems real.
It's very tangible. So Bank Social is a fintech platform built on Hedera. First, they are ISO 2022 certified.
Hold on, ISO 2022, what is that? It sounds like a new droid.
It's basically the global standard language for financial messages. If banks want to talk to each other, especially across borders, they have to speak this language. So Bank Social is fluent in global banking.
Got it. So they speak the language.
But here's the kicker. Bank Social is officially listed on the FedNow Service Provider Showcase.
Listed by the Federal Reserve.
Yes. And we checked. The Fed doesn't just list anyone. This implies a serious level of vetting. And Bank Social connects to thousands of U.S. credit unions.
So why credit unions?
Well, credit unions are interesting because they often lag behind the big banks in tech. Bank Social gives them a way to modernize, to offer crypto services, instant payments, all powered by Hedera.
So connect all the dots for me. Bank Social is on the FedNow list. It runs on Hedera. What does that actually mean for HBAR?
It means Hedera has found a backdoor into traditional banking. It's not asking these credit unions to speculate on tokens. It's offering them a tool, Bank Social, that just happens to run on Hedera's rails.
The Intel Inside strategy.
Exactly. The members of the credit union might not even know they're using a DLT. They just know their payments are faster and more secure. But every single one of those transactions is using the network.
Okay, so we have Davos for the high-level alignment, FedNow for the plumbing. But there's a third piece of research that I think is the biggest validation of all. And it comes from JP Morgan.
Right. This is one that usually makes the skeptics pause.
Yeah.
Because JP Morgan, they are the establishment.
We're looking at a report from their asset management division called Tokenization of Money Market Funds.
Mm-hmm.
And money market funds. That's about as boring as finance gets, isn't it?
It is incredibly boring, which is why it's so incredibly important. We're talking about an $8 trillion market. This is where corporations park their cash. If you break this, you break the global economy.
So they're not messing around with experimental tech here.
Not at all. So when they write a report about using blockchain to upgrade this market, people pay attention. And in the report, they talk about different kinds of networks, public ones like Ethereum, private ones that banks build themselves.
But they land on a third option.
They do. They identify public permissioned networks as the ideal sweet spot for institutions.
Okay, define public permissioned. To a crypto purist, that sounds like a contradiction in terms.
It does. It kind of irritates them. A public permission network means it's open for anyone to use. You and I can build on it. We can send transactions. We can see the data. It's public.
Okay.
But the nodes, the computers that actually run the network and validate everything, are permissioned. You can't just set up a server in your garage and join. You have to be invited. You have to be a known entity.
And in the JP Morgan report, when they give an example of this ideal architecture, they list one name.
Just one. Hedera Hashgraph.
Not a list of options, just Hedera.
Just Hedera.
So why? Why do they prefer this model over something like Ethereum?
It all comes down to governance and accountability. The source talks about the Hedera Governing Council. You're talking about Google, IBM, Boeing, Deutsche Telekom.
The utility cartel again.
Right. If you're JP Morgan moving billions of dollars, you need to know who's running the show. If something goes wrong on a fully decentralized network, who do you call? Who do you sue?
There's no CEO of Bitcoin.
Exactly. But with Hedera, the network is run by real, legal companies with reputations on the line. JP Morgan explicitly says this model gives you the best of both worlds, the transparency of public networks with the scalability and control of private ones.
It really seems like Hedera was designed from day one to be corporate friendly.
They zigged when everyone else zagged.
Yeah.
While everyone was anti-bank, Hedera built a system for banks. And that leads to this key technical point from the source material, which is Dr. Lehman Baird's philosophy on forking.
Right. Dr. Baird invented the hashgraph algorithm. And forking, I mean, in crypto, that happens all the time. Bitcoin forks into Bitcoin Cash. Ethereum forks. It's almost seen as a feature.
It's seen as democracy, but for finance, it's a complete nightmare.
Why? Why is it so bad for a bank?
Okay, imagine you tokenize a real-world asset. Let's say the deed to your house. It's a token on a blockchain. Now, the developers of that blockchain have a big fight, and the chain splits. It forks. Now there are two competing chains.
So now there are two tokens representing my one house.
Exactly. Which one is the real one? Can you sell the house on chain A and then sell it again on chain B? It's the double spend problem on a massive scale.
It's a multiverse of madness for your mortgage.
It is. A bank can't tolerate that. They need one, and only one, version of the truth. They need that finality we talked about.
And Hedera is built to prevent that.
The source explains that Hedera is architected, both technically and legally, to prevent these contentious forks. The state of the ledger will never split into two realities. And that stability is a huge reason why a firm like JP Morgan is comfortable even mentioning them.
Boring is good for banking. But okay, let's get to the part people are probably waiting for. Does boring make you money?
That is the multi-trillion-dollar question.
So the source material gets into some valuation scenarios. And again, disclaimer, we are analyzing the research. This is not investment advice from us. But the numbers they present are, well, they're aggressive.
They are, but they're based on this infrastructure thesis. The argument is that Hedera is a deep value play because it has completely ignored the retail hype game.
Right. They don't have a dog mascot. They're not paying influencers.
No. They're spending their money to be at Davos with regulators. And the source points out that even without the hype, active accounts on Hedera are surging, up something like 3x quarter over quarter. The usage is happening. The price just hasn't caught up.
Okay, so let's walk through the targets the source laid out. It starts with a $2 HBAR.
The $2 scenario is called the infrastructure win. That assumes Hedera starts landing meaningful paid contracts for things like supply chain tracking or settlement. It's the market validating that the tech works at scale.
Then it jumps to $10.
$10 assumes the utility cartel is real and in full effect. This is where Hedera isn't just tracking data, it's capturing a real slice of global settlement volume. If even a fraction of cross-border payments touch the network, the demand for the HBAR token to pay fees goes, parabolic.
And then there was the $20 scenario.
That's the standardization play. That's when the whole market finally realizes Web3 runs on compliance and trust. not just narratives. In that world, Hedera becomes a base layer for the Internet of Value, almost like TCP/IP is for the Internet of Information.
The source also made an interesting comparison to XRP.
It's a logical one. The XRP community often talks about valuations in the trillions if it handles global settlement. The source just asks, if you believe that's possible for XRP, and you see Hedera sitting right next to them playing the finality role.
Then the math suggests Hedera is seriously undervalued relative to its peers.
Drastically. If Hedera captures even a tiny fraction, say 1/50th, of the value the XRP ledger is aiming for, the upside is massive.
The author even noted they're personally building a position, aiming for 1 million HBAR.
Which is a high conviction bet. It shows they're not just trading a chart, they are betting on the plumbing.
So we've covered a lot of ground. The Davos alignment, the FedNow integration, the JP Morgan name drop, the no-fork philosophy. When you take a step back and look at it all, what's the one big takeaway?
The takeaway for me is the shift from testing to production. For the last 5, 6 years, enterprise blockchain was just a buzzword. It was press releases about pilot programs that went nowhere.
Innovation theater.
Exactly. Companies just try to boost their stock price. But what we're seeing now, with something like Bank Social being live on the FedNow list, with JP Morgan publishing this stuff, we're crossing the chasm. We're moving from testing to actual production.
And like the source said, infrastructure moves slowly, then suddenly.
That's the power of network effects. It takes years to lay the foundation, but once it's live, adoption can happen incredibly fast.
I really like the final analogy the source used, short-term checkers versus long-term chess.
It's a perfect summary. The retail market is playing checkers, jumping on whatever token is green today, chasing the narrative of the week, AI coins, meme coins, whatever is trending.
Quick wins and quick losses.
Right. But Hedera and its partners like Google and IBM, they're playing chess. They're positioning their pieces for a game that will play out over decades. They're building the boring, compliant plumbing that the whole system might eventually run on.
And in chess, you don't win by making the most noise. You win by controlling the board.
Exactly. While everyone else is shouting, Hedera is inside the room, quietly setting up the board.
So for you, listening, the question is really, do you want to chase the noise or do you want to pay attention to the signal?
And the signal here seems to be that the future is hybrid. It's not banks versus crypto. It's banks using crypto to become better, more efficient banks. And Hedera seems to be one of the main tools they're reaching for.
A powerful thought to end on. That's all for this deep dive into the invisible plumbing of the future. A huge thanks to our expert for breaking down all the technicals.
My pleasure.
And to you listening, don't just take our word for it. Seriously, go look up that FedNow service provider list yourself. Read the JP Morgan report. Verify all of this. And if you're on YouTube, let us know in the comments, is the utility cartel the real deal? Stay curious, and we'll see you on the next deep dive.